Okay, now we're switching gears. We talked about housing. We talked about the stock market. A lot of potential on the downside in both of those remaining. We're going to talk about a market that's a little bit different in terms of its cycle, but not much. This is crude oil. I'm sure you've heard many words about crude oil during this conference. This is a picture going all the way back to 100 years in the price of crude oil in dollar terms. And the reason I'm showing you this particular picture is that this is a snapshot of the long-term prices in 1998 when oil was just over $10 a barrel. And at that time, this conference had very few people coming because nobody was paying attention to oil. Who cares about oil? It's only $10. Of course, now that it's $90 a barrel, everybody thinks it's a great investment. Back then, and I can't take credit for this, my oil specialist at that time published this picture. Now, if you remember what I said about wave patterns, bull markets tend to go in 5 wave structures, and you'll see the Roman numeral 1, 2, 3, 4. Essentially, he was saying there's a big bull market coming, and he said in print, we're going to bottom near $10 a barrel and go to all-time highs. That's a hell of a call. All right, so as we proceeded along, this is more of a close-up. This is a picture that when I was speaking in March 2006, I brought this picture with me at a conference in Vienna, showing where we were in this wave pattern that we follow in terms of tracking bull markets in various financial instruments. And I said, there's more to go in this third wave. We're not quite done yet. Then we'll have a very sharp drop for wave 4, and then finally the last move up in wave 5, and that'll be the end of the move. Now, take a look at that right hand 1, 2, 3, 4, 5 very carefully, because I'm going to show you a close-up that now brings it up to the current time. Remember, this is March 2006 before that wave 3 high and the wave 4 drop. And this is an update of that picture. Since 1998, at $10 a barrel, it went up in the classic 5-wave structure that we follow. Notice that it did go higher to get to that place where circle 3 is up there. That was $78 a barrel, and then it plunged down to $50 a barrel. That was that wave 4 drop that we showed on the chart. We needed that, and then we needed one more new high for us to say, okay, on a long-term basis, we think this commodity is topping out. Well, and just in the past week, isn't it wonderful how they time these conferences? Oil zipped all the way up, burst through the upper channel line, hit $90 a barrel. Now, sometimes commodities can be unruly, and they get into what we call blow-offs, and they can actually double and then crash. I don't think oil tends to do that. It's a lot more orderly commodity than some of the others. The point being, we're near the end, at least in our opinion, of this very long-term 9-year bull market in the price of oil. Now, some people argue that we're running out of oil. So no matter what you say from a technical standpoint, none of it matters. Earth is running out of oil. If that's true, my question is, how come, in real value terms, oil is no higher than it was 7 years ago? In fact, it's lower than it was 7 years ago. When you price oil in terms of gold, it's cheaper than it was 7 years ago. You know, let's just say it's roughly the same. If the earth were running out of a certain commodity, it should go up in terms of any measure that you pick, truly indicating a shortage. But what's happening here is that inflation has raged long enough that people are readjusting certain prices in an emotional way, and that's why they're tracing out 5-wave patterns in oil and gold and a lot of other commodities. That's all there is to it. According to this, the world is not running out of oil. That's not a good reason to ignore all of these technical indications. Now, the next chart I think is also fascinating. Everybody remembers the 1970s, right? Oil started going up in late 1973, and the stock market entered its biggest drop in 40 years. So as stocks are going down, oil's going up. Not this time. This is a very different environment. If you think it's the inflationary 70s all over again, I'd like you to look very carefully at this graph. This shows that since 2002, actually earlier in terms of the cyclicals ups and downs, the stock market and the oil market have basically been trading in the same way. At Elliott Wave International, we've been calling this, ever since 2002, the all the same markets phenomenon. It's amazing how liquidity, by which I mean credit, has been making all these markets ebb and flow together. Now, what's fascinating is the last time there was extreme optimism and bullishness on both the stock market and the oil market was September of 2000, over on that left-hand side. At that time, the daily sentiment index of traders, there were 93% bulls in the stock market, and bullish consensus was 91% in the oil market, and they peaked in the exact same month. That was in September 2000. It's taken all this time, we've gone through waves 2, 3, 4, and 5, to reach the same extremes in both markets. The percentage of bulls among advisory services this month was the second highest in the 21-year history of these figures. That's way before, the 1987 drop. And the oil market, bullish consensus was 89%. That's the highest in 7 years. In other words, in both cases, the highest since the double peak in September 2000. So what I'm saying is we're in a period of extreme optimism on two markets that generally, or at least in inflationary times, don't move together. This time, they appear to be making a top at the same time. Now, I think this is important because the driver here is not money inflation, it's credit inflation, it's IOUs. And that is why the T-bills are not paying very much interest. Instead of going to 5% and 8% and 10 and 15 and 18 as they did in the 70s, they're just stuck down here at a very low level. There's tremendous optimism throughout the system. Well, the optimism behind the credit is beginning to crack. This is a quote from Chuck Prince, the CEO of the chairman of Citigroup. He said this on July the 9th. When the music stops in terms of liquidity, things will get complicated. Now, when a banker is going to represent one of the biggest banks in the entire world, he's not going to lay it on the line, in bare terms like we do here at this conference. He's going to be a little bit more diplomatic. So he used the word complicated. What he meant was there are going to be serious credit problems in the banking system when the music stops. In other words, when the borrowers stop borrowing and the lenders stop lending because they are simply lent out. Well, shortly after he made that comment, as the previous speaker showed you, there was a collapse in the amount of commercial paper outstanding. This means the first crack in the debt structure. People are saying, I don't want your commercial paper that's backed by assets. Thank you very much. This is the first time in all this period when finally the lenders are saying, no, thank you. We're not going to give you our money for this speculative purpose anymore. And if there has begun a crack in the debt structure, that's going to mean an inflationary top in the stock market. We've already had one in real estate and oil and probably many other commodities. This is a quote that I got. I wish I'd said it myself. I couldn't figure out a way to steal it, so I decided I better give him all the credit. This is from David Rosenberg. He's an economist at Merrill Lynch. He looked around recently and he said, as for reflation concerns, we do not see anything left in the U.S. economy to reflate. And I agree with that. How could you possibly find worse, less qualified borrowers than they found in the housing market? How can you lend more than 30 to 1 leverage to hedge funds? Well, maybe they can go to 40 to 1. I mean, 30 to 1 is unbelievable, and they're the ones buying the commodities. What about the stock market? It's so leveraged. People have borrowed to buy stocks, and it's hedge funds and other types of funds on leverage. I don't think there's anything left to reflate. So as a contrarian, I guess I'm saying something a little bit unusual at this conference, but I think we are seeing a peak, plus or minus a year. I mean, this is not pinpoint science. It can't be. In the inflated value of financial assets across the board. In other words, I think it's 1929 on steroids. At that time, we started a slide in the stock market and commodities across the board, and they all fell individually approximately 90%. Now, I don't know that that's going to happen immediately. I may be back here next year saying the same thing. Well, now we've got 40 times leverage and even worse borrowers in homes. But I think we are at a super extreme in all the measures I've just shown. I did want to leave you with one piece of a good feeling. In talking to people around here, I don't detect too many Hillary Clinton fans. I would like to say that I've been forecasting since 2001 that she's likely to be our next president. And the good news is, if you want somebody to ride the downside, like Herbert Hoover did or Martin Van Buren did, You want it to be somebody you really don't like. Thanks for your time.